Welcome to our eSignal Weekly Forex and Futures Forecast. My name is Jay Norris. I teach trading at Trading University. First market we're going to get to will be the Australian US dollar. Aus US dollar in an interesting place on the chart. We're pretty excited about that. We've got big time support just below 70 even. Let me pan out to a monthly chart and you'll get the big picture. We've been talking about that level for some time. We think price-wise, you're very close to a bottom. Time-wise, maybe not so much. It's going to take some time. It may take weeks, even months for this market to carve out a bottom, particularly with the sharp downside momentum you have here. There'll probably be probes well below 70 even. On the other hand, long term, we think this is going to be a very interesting level to consider dollar cost averaging that market. So price-wise, we think you're very close to a bottom. Time-wise, you're probably going to still need some time to carve out that bottom. Dollar Swiss, the next market. Like all your dollar pairs, this market recovered nicely the second half of the week. You held that support there. You held 2/3. Essentially, this pattern, this secondary pattern, we'll call it, from the May low to the August high, that held bullish. You got one close below it. You need two closes below it to shift the pattern. Never got it. So that pattern remains bullish. That's a big pattern. We think in the big picture, pop out to a monthly chart, that it's not a matter of if, but a matter of when you take out this resistance, that trend line there. We think you're going to do that, and you're going to have a lot of room on the upside, and that's going to be a real boon for longer-term investors who are holding this guy. There's the dollar index. I guess we'll talk about the big picture first. Potentially, you had a big breakout in the beginning of this year, and we think that's going to follow through down to a daily chart. We really see the last 5 months or so as an area of a consolidation, what a technician would call essentially a bull flag. And we think when you break out of that bull flag on the upside, that there's going to be a lot of room in the dollar index. We think you're going to break out of that when the U.S. Fed raises interest rates. You know, there's a lot of talk in the press and on the boards as far as the Fed, when, if they're going to do it. They're wishy-washy. To me, it's pretty simple. I would give investors the same advice that a parent might give a child when the child says, hey, when are we going to get there? When are we going to arrive? Well, we're going to arrive when we arrive, right? We're going to get there when we're going to get there. The one thing you can't count on is interest rates are going to go higher. The Fed will raise interest rates, and that's going to be dollar bullish. When that happens, you better be long the dollar. Next market, the euro. As bullish as I am the dollar long term, it had to be equally bearish. The euro, I think you kicked out a lot of shorts in that market, and that's what you need to do. Market makers, they needed to reset that market. You needed to have a capitulation in order to get back on track with that overall bear trend here, right? That's what markets do. So from our perspective, both on a short and long-term basis, we're back on the short side in the euro. Friday, it gave a nice sell signal here. We'll kind of do the opposite. Usually we pan out here. I'll go short term. I'll show you a nice little retracement on an intraday chart that occurred Friday that tells us that it's safe to be back on the short side in the euro. There it is. Look at that. You take Thursday's high to Thursday's low. It gave a perfect 2/3 retracement. Kissed 2/3, gave the sell signal there, and bam, look at that, euro went down. So both from a long-term and a short-term perspective, we're back on the short side in the euro. Glad to have gotten that late summer dog day correction out of the way. We're coming into September. As it turns out, the U.S. economy's really shifting into high gear as well. You had a GDP number north of 3.5. That's very bullish. U.S. consumer confidence is above 100, those readings. So a lot going on in the U.S. economy. And the U.S. economy right now, it's really like someone who's just getting the groove of working out, right? When you get it, it takes a long time to get into that groove. But once you get to that point and you start progressively getting in better shape, it's not going to turn around. As long as you continue to work out, you're going to continue to get stronger, and that's where we're at in the U.S. economy right now. Next market, the gold market. There's gold. I had a nice gold trade earlier in the week there. You're in both a shorter term and a longer term sell zone there. You can see those two zones overlapping. Glad to have gotten, again, that short covering rally out of the gold there. We talked about that. The the likelihood of a intermediate term bottom there. You got that bottom out of the way. We don't see gold having a whole lot more upside, and longer term, pop out to a weekly chart here, we're still singing the same song. You got to sell rallies. And the last market we'll cover will be 10-year interest rates in the United States, because that's the market that everyone's watching for clues as far as when are rates going to rise in the U.S. And again, it's not a matter of if, but when. And here's a daily chart of rates. You can see the interest rate on the right side. You can see 10-year rates got as high as 2.5%, just shy of 2.5% in the spring, and now the rates came back down. They bottomed just below 2%, and now they're on their way back up. We think that support zone held. You see that green box, that's our support. It held. You took out later in the week, you actually took out this that summer bear trend line, so you're above the bear trend line. So we think it's back on the upside for U.S. interest rates, and of course that's going to be dollar supportive, and it's going to feed into the U.S. economy too. It's going to help out savers. It's going to give business a lot more confidence too. So we don't think that 3.7% bump up, that rise in U.S. GDP is a fluke. In fact, we think you're going to see that number continue to strengthen as U.S. consumers continue to feel more and more confident. Long term, we're whistling the same tune, dollar strength. My name is Jay Norris. I teach trading at Trading University. Thank you so much, and we'll see you next week.